Good stuff. Break's 11 o'clock, I think, so we should get going. My guest this week is Prashant from Ashoka White Oak Emerging Market Trust, so we'll be talking to him in a minute. But before we do that, we've got a bit of news to cover. So three things that I pulled out from this week's news. We'll run through them in order. So Brown Advisory US smaller companies first. To be honest, given how dominant the US market has been, how well it's performed, most smaller companies have lagged, but this fund has lagged the benchmark for US small companies as well. You can see it's sort of gone sideways for quite a while now. It's not very big. It's the smaller of the two funds. I'll show you actually how it compares to the JP Morgan fund, which is the only other US smaller trust that we've got. And you can see that it's smaller. It trades on a wider discount. It's more expensive to run, and it underperforms it by quite a margin over most time periods. Really not too great. And then if you look at its own stats, you can see how poorly it's doing relative to its benchmark. So their sort of cumulative basis or 12-month returns, not very good. So what the board has decided to do, first they're going to tweak the management fee. The first part of that, so based on the lower market cap and NAV, will make more of a difference in the short run, but they're also cutting the first tier of the fee. So you can see that it drops from 0.7 down to 0.65 of the first 200 million assets. So that will help a bit and will bring it closer to the going charge on the JP Morgan fund. But that's only sort of window dressing in the great scheme of things. They're also saying, if we don't turn performance around, we are going to give you the chance to get out at NAV. And the trigger for this is a 5-year measurement period that ends on the 30th of June 2028. So we've already quite a way into that period already. And at the moment, they've got quite a way to make up. So they're almost 13 percentage points behind the Russell 2000 index. And they'll have to make that up and maintain that outperformance all the way through to the end of June 2028 if they're going to avoid this. And in the meantime, they've still got continuation voting. So I think this is a fairly bold move by the board. It probably preempts any kind of attack from anybody else. And I think shareholders will welcome this, but obviously we'd quite like to see the performance turn around. QuotedData Green is one where they've already thrown in the towel. We knew about that in December. It was all announced just towards the end of the year. It's not very big, and that's part of the reason why they've decided to give them up. So what they've announced today is how that mechanism is going to work. So it's a normal kind of Section 110 scheme. So we've used these in mergers and stuff all the way through the last sort of couple of years. But here you get a choice of cash at NAV less costs, former asset value, RFAV, or a rollover into an open-ended fund. And the beauty of rolling over to an open fund is that you don't trigger capital gains tax. And this, that we'll talk about in a minute, is exactly the sort of playbook that Saba is trying to use when it's going off to its next set of targets. I think that I'd still prefer to be in an open-ended fund, and the only option here, the closed-end fund, and the only option here is Impact's environmental markets. It's got much better long-term performance than the Jupiter Green fund, much lower charges, it's a much bigger fund, much more liquid, and you can still buy it on a 10.6 discount. So you can get out of this as a value and roll into Impact's at 10.6. That's what I would do if it was me. But the rollover option that they're offering is unit trust. And it's a UCITS fund. It's basically the same kind of remit as Jupiter Green. It's a much bigger fund, 685 million. And because it's got quite a similar remit, it's got quite a similar portfolio. So that actually the cost of shifting the assets into the UCITS fund is not going to be very much at all. But it actually covers a higher ongoing charges ratio. I mean, people are always banging on about open-ended funds are more efficient than closed-end funds. I don't generally find that's always backed up in practice, and you've got a direct comparison here between an open-ended and closed-end fund, and the closed-end fund is cheaper. But the thing that might skew people's decisions, and this is why I'm sort of saying, when I take a look at impacts, is that the performance of the open-ended fund versus benchmarks is not great. So the two things that they've chosen to compare it to are the MSCI All Country Swap Index, so just generally what you could get from the whole market. And as we know, it's been skewed by US stocks. And also they're comparing it to the global funds. So because there isn't an environmental sector in the Investment Association, one of these things that they don't actually completely match all the sectors that we've got and investment companies. So it's environmental, as we know, has struggled a bit, and this fund has struggled relative to those benchmarks. And you can see it here in the cumulative figures, sort of 1, 3, 5 years. It's quite a long way behind. Relative to the world index, it's a long way behind over 5 years. The surprising thing for me was how badly the Investment Association global funds have done over 5 years. So they're much closer to Jupiter Green, which has got all these constraints about what investor and the environmental stuff, whereas most funds in that global sector won't have those constraints. And that seemed quite strange to me that they've done quite that badly. That's something for another time, though, to why they've underperformed. Anyway, so there we go. You might look at those numbers and think, I don't really want to do this. I'd much rather have the cash and then maybe choose what to buy instead. And in terms of the practicalities, they keep a tiny bit back in liquidation pool. Our expenses associated with this of 745,000. These are not cheap things to do because you have to have all these different meetings and all this paperwork you have to produce and liquidators you have to pay for. And this is all to be borne in mind when you're thinking about the Saba thing. But because there's a rollover option, Jupiter Asset Management is going to make a contribution to all the total costs. I looked through the announcement. I couldn't find out how much that will be, but it does look to me as though it's going across all costs. So it's not just for the people that roll over. And then in terms of the timing, as we know now, because we've done this voting with Saba, you have to get your votes in early. So the closing date is the 3rd of March. If you actually want to vote through a platform, you probably have to be a week or so before that. And choose what you want to be invested in, cash or rollover by the 4th of March. If you don't tick the cash box, or if you don't actually submit anything, then you're going to automatically roll over into the open-ended fund. Then there's a meeting on the 5th of March. Last day of trading, you won't be able to do the shares after the 7th of March. And then the second meeting, 14th. And you'll get cash towards the end. Which brings us on to Saba and 2. So it's trying to do the same thing, or basically it's called meetings to ask that these 4 do the same thing. So offer a choice of cash or into an open-ended fund. This is going to be, it's a different proposition to what they put forward before. I still think there's going to be a lot of resistance to this because it comes back down to this point that we make it all the way through the first round of Saba stuff, which is that you probably don't want to be selling these trusts now. You want to retain the exposure. But if you go into an open-ended fund, well, first does the open-ended fund exist? Then the managers of these things are currently, these are all out of favour, they're faced with redemptions, they've got to keep cash on hand to fund that. If the market dips again, they won't have cash on hand to buy cheap stocks. There are good reasons why, in terms of poor performance for a sector, trusts do better because they can lay the foundations for better performance down the line. I think that's something to bear in mind. I mean, as somebody else has pointed out, everybody who's a shareholder in these things chose to be invested in a closed-down fund rather than an open fund. They don't necessarily want to make that switch. Now, the thing with this, because it involves liquidation, it needs 75% of those voting to approval to push it through, whereas the previous ones were 50-50. That makes Saba's job an awful lot harder in terms of convincing people. It's interesting. I mean, I completely understand frustration here. And boards generally do quite reserved in what they say. But City Natural Board has made the point, bottom there, this is a complete waste of time and resources and shareholders' funds. They were already looking at what they could do to give those people who want to out now, if that made sense. That whole process, you don't need to have all these meetings and just rush the whole process. So they're quite upset about it, and I understand why. Quite a surprised one, we've seen the European smaller companies requisition withdrawn this morning because the board said, we talked to Saba saying, look, probably the same sort of thing. Down the line, they're thinking about what to do about your stake and how we're going to get you out. So give us a period of time and we'll see if we can come to a arrangement that makes sense for everybody. And this is the key thing, really. All these proposals, you've got this massive overhang of stock. Boards must weigh up whether giving Saba an exit is actually going to be counterproductive for everybody else who raises a shareholder. Obviously, if you shrink the assets down, then the interest ratios tend to go up. That's a bad thing. Liquidity goes down. There's all sorts of reasons why it's bigger funds are better. As we know, there's been quite clamor for bigger funds. So routinely shrinking things in the way that Saba wants to do is not necessarily a good idea. Anyway, there are no meetings yet. Nobody's actually put forward a circular yet. That will all happen in time. Just kind of watch this space. So that is enough from me.